Good afternoon. This is Michael Douville, and we're coming from beautiful Phoenix, Arizona. I am privileged to have Walter Zimmermann with ICAP with us today. This is a Creating Wealth webinar, and we're going to discuss the economy. We're going to discuss some of the events that are going on. We're going to talk about the markets. We're going to talk about interest rates, and hopefully, if we have a little bit of time, we'll talk about real estate. But I want to introduce Walter Zimmermann. I've known him for a long time. He's a brilliant, wonderful man. And of course, you'll see him from time to time on Bloomberg News, or you'll see him on CNBC, and he's graciously agreed to meet us with us today. So hi, Walter, how are you? It's good to see you again.
Great, thank you. Now that you've raised the bar so high, I hope I won't disappoint your viewers.
Oh, there's not possible. You know, I did want to bring up a couple things. You made an amazing call on oil that you've been talking about really almost for 17, 18, 19 months. You were looking for oil to drop to $17.30 a barrel, but you did it from a very, very long perspective. And that goes back to your type of work. So you're an expert in Elliott wave analysis, are you not?
Yes.
So how did that come about?
Well, in graduate school, I stumbled on a 30-year commodity cycle, which works exceptionally well for crude oil. So when crude oil spiked to 150 bucks in 2008, that was my timing window for a 30-year cycle high, which meant 15 years of decline into 2023. And so the time cycle gave me the timing, and Elliott wave from 150 a barrel gave me the target of hitting the teens by 2023. And then as the pattern was unfolding, that target for the teens remained intact. And the last rally was into 2017, 2018. Brent crude hit 17, it hit 87 on the rally, but that was a failure into key resistance. So the target for the teens remained intact. And then coming into 2020, I was still targeting the teens, but ideally into 2023. But then COVID-19 came along, and I call COVID-19 the great accelerant, because anything that was going to happen anyway in the markets happened much more quickly. Declines that would have taken years took months. Declines that would have taken weeks took days. And no market was immune for this. So I notified clients, well, I know I've been targeting the teens for crude by 2023, but we shouldn't be surprised if we see it this year because of the accelerant nature of COVID-19. And sure enough, we saw 1598 Brent and a nice rebound from there. Now, that cycle low is still due out in 2023, so I suspect we may see a double bottom out in that timing window. I don't think the problems of crude oil are done yet. And this goes to drill baby drill means glut baby glut. There's a chronic glut of crude oil, of gasoline, of diesel, of natural gas, and that's going to be impacting the markets for years.
And of course, we've got some very substantial changes in the economy where people are going to electric cars, electric vehicles.
Oh, absolutely. Absolutely. I did a 40-page report on the electrification of ground transportation back in December, pretty much concluding that by 2030, it'll be difficult to buy an internal combustion engine. And at the same time, there's a revolution going on in electrical generation that there's a utility in Australia, a wind farm with a big Tesla battery that is driving the natural gas and coal electrical generation business bankrupt, basically. So that's another level of dramatic transformation on tap.
So in your cycle, does your cycle, is that also a commodity cycle with the oil? So are you saying you think commodities will be down until 2023?
Yes, and actually, there won't be any sustainable relief until 2023. But then for the oil sector, I don't know if there'll ever be a sustainable recovery because of the wave of electrification that's approaching. And curiously enough, there is an equity time cycle that has a major low due into 2024. So 2023, 2024, it looks like deflation will be the prevailing force until we're through that timing window.
So do you think that's kind of like we're going to work through all the problems? Because I know we have an awful lot of zombie companies. We have an awful lot of bonds that really should have been issued, an awful lot of debt that shouldn't have been issued.
Yes.
And I know the Federal Reserve is doing absolutely everything they possibly can to keep the ball rolling. But a lot of these companies really just don't have the wherewithal to really service the debt. Are you thinking that this is kind of like a reset that's going to be coming through in the next couple of years?
Yes, I do. And, I think we can give up on inflation because with so much money looking for the slightest uptick in return, traditionally inflation begins with commodities, seeps into manufacturing, and then eventually ends up in wages. But every time a commodity has tried to rally since 2008, there's been an avalanche of funds pouring money to drill more, mine more, grow more. So you get a short spike in commodities and then an enduring collapse and years of overcapacity. And that's because the Fed has made people so desperate for any kind of return. So the law of unintended consequences, I think, applies here. The Fed's desperation for inflation is making inflation impossible. And with a giant debt bubble, you really need inflation. And if you don't get it, you're in trouble. There's deflationary forces that can be crushing for a debt holder.
So I guess to follow on with that, if you think we're not going to have any inflation, are you thinking that interest rates are going to stay fairly low for the next 4 or 5 years?
Yeah, I don't see any way even the Fed can allow them to recover, because now the Fed is holding billions in assets whose value will collapse if interest rates recover. The Fed would have to be bailed out by Congress if they let interest rates recover, because all their assets will get crushed. Everything they've been buying will get crushed if interest rates recover.
Well, it's funny. I'm doing a webinar next week, and one of the themes was it's bonds, James bonds, licensed to fill your portfolio. So I'm thinking you got to be out of bonds, because debt would just be the worst thing in the world to possibly happen in any kind of rising interest rate environment. It's just going to destroy that. So, so what do you think the Federal Reserve is going to do? They keep saying and they keep promising we're not going to go negative. We're not going to go negative. And the more they say that, the more it thinks we're going to go negative.
Yeah, the more it sounds like statements of desperation and hope than of assurance. And the other issue here is the Fed has, on purpose, created another bubble in equities. This is the wealth effect. If they can get the stock market up, the theory goes, people will borrow more and spend more and will recover. But they've recreated the same overvalued stock market we had in early January. And Powell owns this bubble. It's priced, the stock market is priced for perfection again. So anything less than perfection that comes along, the Fed's going to have to throw something at that. It's going to have to buy more. It's going to have some new program. And it puts the Fed in a very difficult position. They own this bubble and they can't allow it to burst. But how do you prevent a bubble from bursting?
Well, do you think they're going to be going into some of these yield curve controls that they've been talking about? This is in the news right now. Do you think they're going to be exploring that? I know we went negative for like 2 or 3 days, really, on the 30 and 60-day bills. And in my business, most of my clients are baby boomers. They're looking for an income stream for themselves, and as the rates get suppressed, there's really nowhere for them to go to earn income. And even though their stock portfolio may be up, they have to keep selling their assets in order to pay the bills.
Yes, and retired people probably shouldn't be 100% in equities as they are now, but they feel they have no choice, and that makes these huge swings even worse. Everybody I know that's retired wakes up in dread at what the stock market has done overnight because their retirement is at stake. And this is a terrible situation for the Fed to have forced this on them. But the Fed sees no choice. It's a difficult situation all around, really.
So, so far as yields, so like a baby boomer, they're kind of, where do you go to get yield? I mean, really, literally, where do you go to get yield?
Yeah.
I mean, most of these pension funds that I talk to pension funds, and of course they have a 4% burn rate, you know, because they have a payout, and a lot of the pensioners, of course, are no longer adding to the pension; they're subtracting from the pension. So they've got this no yield, and they've got their balances keep dropping. And of course, this is going to add to a pension explosion and a pension crisis in the not too distant future. I don't know what can be done about that.
Oh, absolutely. The business I'm in, nobody has a pension. And so when I talk to people that have a pension, they say, oh, how are you going to retire without a pension? And I'm like, are you sure you have a pension?
Yes.
How funded is your pension? Have you looked into it recently?
Unless you're with the federal government, I think you're in trouble. You know, because the states are broke.
Yeah.
The states are broke. I mean, how is Illinois going to fund a pension?
Oh my God.
How's this going to happen? How is California going to? I don't know if they can put the electrical lines in California, let alone fund the baby boomers.
Oh, absolutely. Absolutely. So there's bad news on tap. There's no doubt about it. And the Fed is now in a position where they can't allow bad news. So it's not, and plus, just over these last few weeks, the stock market has formed this, what's called a gap island reversal top. It gapped up, stayed high for a few days, and then gapped down. Now, you normally see that kind of pattern in very volatile commodities or in penny stocks, or you saw it a lot in the dot-com bubble. But the S&P 500 showing a gap island reversal top, and this most recent rally attempt when the Fed announced they were going to be buying corporate debt for individual corporations, you had a strong rally. Where did it peak out? Right in the midpoint of the gap down. So the whole situation is the most ominous picture I've ever seen in the stock market in 40 years. The S&P 500, 100, NASDAQ, New York Stock Exchange Composite, they shouldn't be acting like penny stocks, but they are.
Well, and the NASDAQ hit a new high.
Yes, it did.
And of course, you know, we have not really felt the effects of the recession because, as you say, this catalyst, just we were standing on the edge of a cliff to begin with because you could see industrials, manufacturing, and freight were all slowing down radically. And then we had this catalyst just come in and just knock us literally off a cliff.
Yeah.
And I don't know that we've really noticed the fact that there's no earnings.
Absolutely. Absolutely. And regard the NASDAQ, actually the NASDAQ never broke down like most other indices did. So I still had a target for new all-time highs in the NASDAQ, and we hit that target. But now what? You know, and the NASDAQ, when you look at it, is about as far from the reality of the average American as you can get. It's Netflix, Apple, Amazon. It's everybody's buying those handful of stocks, and that's powering the NASDAQ. But meanwhile, where is real demand? What's happening to retail? You know, what's happening to what's the future of the unemployment checks?
And what's going to happen when the unemployment checks run out? Because we've had this stimulus that's come out and really kind of softened the blow for everyone.
Yes.
And the liquidity that's been put into the system has been just this side of unbelievable.
Oh, absolutely.
So you and I talked about in 2015 and early 2016, you said it didn't matter who was going to be elected, the economy is going to do very, very well.
Yes.
And
yes.
I think a lot of it had to do with all the QE3, I think it was, wasn't it? Was it QE3?
Yes.
Well,
yeah.
What's going to happen to all this liquidity? We just put in $6 trillion worth of liquidity in 10 weeks.
Yes.
And then Munchen came out and said they're going to put another $1 trillion in.
Yeah.
Where
Well,
is
I,
this
I
going to
can
go?
understand their fear and desperation. They're trying to prevent the next Great Depression because that's the risk if they don't inject enough liquidity. That's the lesson from 1929, that you can't be shy about injecting liquidity. But is that going to be enough? This is an experiment without precedent. We can't look back and say, oh, the last 10 times we were threatened with a Great Depression, this amount of liquidity worked. We're going where we've never gone before. Everything's in uncharted territory. So I understand their fear and their eagerness to inject more liquidity at the drop of a hat. And I can see that that would fully inflate the stock market bubble again, but will that recover the economy? That's an entirely different question.
Well, and of course, the economy drops so far and so fast, it looks like maybe it's bottomed, but it bottomed at a very, very low basis. And I think
Yes.
the technical term for the ending of a recession is that it's no longer going down. It's no longer getting worse.
Yes.
So,
Yes.
so maybe it quit getting worse, but I don't know that it's going to look much like a recovery at this juncture.
And let's remember the last recovery was a jobless recovery.
Yes.
Everybody's forgotten that. They think the jobs are going to come stampeding back. Well, wait a minute. What happened after the bursting of the credit bubble and the housing bubble? We had a jobless recovery, and that jobless nature of the recovery went on for years. And that was from a much higher level of employment and a much lower level of unemployment than the company is suffering from now. And the one factor that really has me worried is the gigantic spike in the personal savings rate. We have a consumer-based economy. And you look at that huge spike to like a 33% personal savings rate. It's gigantic. It just sticks out like the proverbial sore thumb on the hundreds of years of data. And you have to hope that maybe that's because consumers were not able to spend because they were stuck at home. But if that personal savings rate does not start falling sharply, then the economy's in real big trouble. So that's the one thing that, if anything keeps me awake at night, it's how quickly will the personal savings rate fall off its stupendous heights.
Well, the U.S. consumer loves to spend. I can tell you that from personal experience. We
Yes.
think it's patriotic at my house to go and buy. So we do that. Of course, the U.S. consumer is holding up the world.
Yes. Yes.
So they need to open up and get and the retailers, of course, have really had a hard time. A lot of these guys are not going to come back. A lot
Yes.
of jobs aren't going to come back. A
Yes.
lot of restaurants aren't going to be coming back. A lot of bars, and of course, we're 70% of the economy. Most of us are in service.
Yes.
So if the service industry is really in the dumps, that's to be expected. It seems like as we're trying to open up the economy, that we seem like we've stopped. At least we're not dropping any further. So I guess that's a good sign. But if in my limited knowledge, I remember 2000 at the dot-com bubble and the real estate bubble, the market had two legs down, did it not? Didn't it? It went down,
Yes.
it V'd
Yes.
up a little bit,
Yes.
and then came down again.
Yes.
It's not
Yes.
unusual for a stock market to go up 40%, 41 or 42% from the bottom
Yeah.
on a rally.
Yeah. The typical recession is a three-wave pattern. You get the initial leg down, then you get a bear market correction, and then you get the final punishing leg down. And those bear market corrections in between the two major legs down can be very impressive and inspiring, but also dangerous.
Yeah.
If you buy into them too high, you risk getting caught in that final leg down. And I'm very confident that the initial leg down we had was only that, only the initial leg down. And this recovery, so-called recovery, Fed inflated, reinflated bubble is the bear market correction. And there's still another leg down coming. So I'm advising clients that a great alternate investment is the sidelines. and instead of equities. It's like, well, what sector do you want to be in equities? Well, there's no sector I want to be in. The sidelines is a time-tested alternative investment in times like these.
So maybe cash is not trash? Is that, is that?
Yeah, maybe. And of course, real estate, investment income, people do need a place to live. And you know, that's something I've taken advantage of and encourage others to take advantage of. Those rental checks help.
Well, thank you for that, Walter. I appreciate that. And
Sure.
we've been very, very concerned. My asset class is very, I mean, they're all long-term. We don't do anything flip and buy and flip. Most of the stuff we buy, of course, we keep for a very, very long time.
Yes.
And we're very, 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 very concerned. I mean, my clients are baby boomers. We can never get our money back. So we're really, really careful with our money.
Right.
So we're in that class apparently like you are. We're looking just for single family residences where people,
Yes.
that are really kind of like entry level or just above entry level that someone can rent and live there for a long time. That's because our baby boomers, they need income. They're not really in a capital formation anymore. They're in the income. They need income. They need to, what they need to do is they need to transfer their wealth into income. And it's a very, very difficult to find a vehicle that they can do that. Everybody loves to be in Amazon and Apple and Netflix and see their asset base go up, but they don't throw off any income for you. So you're constantly selling your position, and that's a very, very hard thing to do, particularly at my age. No one wants to sell their nest egg at all.
Right.
So I guess the question is, where do you go? Bonds, of course, are really at risk. I mean, we're telling everybody get out of bonds. Even foreign debt. I mean, I think we may have a bifurcated marketplace where you have the federal treasuries, which are I think will always be good, and the rest of the world. I mean, literally the rest of the world. I think sovereign debt in Europe would be a crazy thing to own. Or emerging market debt. I think that'd be awful. And of course, what can you do with municipalities? Would you want Illinois debt or California debt? I mean, I wouldn't want that. That'd be an awful thing to have.
The tax-free return is overshadowed by, will there be any return of principal?
Yeah, at all.
At all. Yes.
Yeah. So where do you go? So in your opinion, there's a lot of risk in the stock market. Maybe one more leg down.
Yes.
And that could be a pretty severe leg, because if we remember the last two market crashes that we've had, the last two recessions, we've had this bear market rally is pretty impressive. Yes. And then the following one was really crushing, and it was longer.
Absolutely. Brutal.
Even though the economy is trying to recover.
Yes.
The market was really almost like coming to reality.
Yes.
And that seemed to be like a lag. And so where do you hide? I mean, we can go into a little bit of real estate. What other asset classes do you think you can hide in? Cash, of course. Small bills.
Cash. There's nothing wrong with treasuries. There's nothing wrong with real estate. And the other, I think, opportunity here is successful people who have been trapped in the big cities, from what I can see, are really looking to get a second home out in the country and maybe leave the city behind. And here, I think there's an opportunity not for entry level, but for more upscale, because these are successful people, and they've the deprivations of being trapped in a tiny, though luxurious apartment in the city for an extended period of time wears thin. And I suspect there will be a market for more upscale second homes in areas maybe 1 to 2 hours outside of every big city in the country.
Very, very, very insightful on that. That's like being on the nicest suite on a cruise ship. that you can't leave your suite.
Yes, yes.
Who'd want to do that?
Exactly.
I think I'd rather be up on deck somewhere.
Yes, even sleeping on deck.
Yeah, sleeping on deck would be great. So let me just segue a little bit. All this liquidity that's going in, do you have a time frame? Because I'm looking, you've helped me a little bit with, I've been following your work, and I have a timing model myself. It looks like maybe we're going to bottom in the next 60 to 90 days in the next quarter, but we have a very, very slow recovery. I'm looking, we're not even really, we may have bottomed, but it's not going to feel like you bottomed.
That's right. That's right. And that's generally what happens. The stock market is not recovering, but somewhere out there, the economy is improving. And generally what happens is everybody gets bearish at the lows, which is the perfect counterpoint to the fact that they're all bullish at the highs.
Right.
So the stock market looks worse and worse as the underlying economy is improving. And then finally you get what's called capitulation. The bulls give up, they evacuate, generally at the lows. That's the most bearish extreme, that moment of capitulation. And that's the moment of maximum opportunity for the savvy investor who's been sitting on the sidelines, keeping his powder dry, waiting for that capitulation to pick up assets for pennies on the dollar in the equities and otherwise.
Do you think maybe still a year out, 18 months out, or do you think it'll be sooner?
Well, there's still that nagging problem of the time cycle says 2024 for the final lows. But then how much has COVID-19 sped that up?
Amazing.
Yeah.
I mean,
yeah.
And we used to just kind of do a gradual slide into recession. This was like just falling off a cliff. This was taking the elevator down.
Yeah, this was normally, you take the stairs down. This was a trap door opening.
Exactly.
This was an elevator shaft.
This was like, wow. So I think that's probably why we're going to. I think it's maybe one of the shortest recessions we've ever had. It was nasty. Probably one of the worst recessions we had, but with a short brevity. But the recovery might be long. I'm thinking maybe 2022 before we really start getting back.
I agree. I would have to agree with that. And maybe not until 2023 will it start looking really nice and wonderful again.
So that's about 18 months away.
Yes.
So my understanding is now we put, if you look back at the charts, like what we did in 2015, when all that liquidity was coming into it, it took about a year and a half for that liquidity to work through into Main Street. And by the time we got into 2016, late 2016, 2017, the economy was looking pretty good.
Yes.
So if we extrapolate that out from now, we just got $7 trillion. But and again, it was like a trap. It was like a rocket ship straight up. It wasn't like it was gradual. This was like an instantaneous 10 weeks, $7 trillion, and holy cow.
Yes.
So do you think it's going to take that long for that liquidity lag to start showing some effects on Main Street?
I think so, because the unemployment rate was so high. It's much easier to lay people off than to rehire them. It's much easier to furlough than to decide now's the time to try and rebuild the business. I think there's this unwillingness to jump in wholeheartedly here. I think people are going to be more cautious, more careful, more prudent than they were with the last two recoveries. But we made it through the bursting of the dot-com bubble. We made it through the bursting of the credit bubble. We're going to make it through this, but it's going to require patience and I think caution, and probably more prudent to be a little late to the party than a little early in that regard.
Well, and of course, once liquidity starts going, I guess we're looking for that virtuous cycle to start. So we start getting slowly where we've stopped going down, and then people start spending money, like you've mentioned in retail. They start taking money out of savings, start actually adding furniture, buying TVs, or going on vacations. And of course, once that virtuous cycle, so we certainly will recover, but you're looking at the same time frame. I think you and I are both on the same wavelength. We're looking for probably 2022 before we can say that we can smile again and laugh and sing, and things will be better.
And this relates to the fact that no pandemic in history has been one and done. No pandemic has ever been one wave. There has been a couple that were immediately geographically isolated that were two waves. Otherwise, every pandemic in history, and this is going back to like 400 BC, every pandemic has been at least three waves and occupied a couple years. And generally, it's the second wave that's the worst because the virus mutates to a more aggressive form. Now, there's nothing saying that it must be three waves again, but when you look at the history and you can't find an example of a pandemic that was not three waves, that's another level of caution that I think people who do the research will be stuck with, and probably to their benefit.
Okay, so we're going to come out of this.
Yes.
So we should all just kind of batten down. We should get very conservative, get cautious. This is not the time to try and make your fortune on a penny stock, or start. We should be trying to buy Hertz at this level. I don't imagine that's probably not that's probably not the stock.
I'm glad you mentioned that. That's an example of the hysteria of the bullish excess that has reinflated this bubble. When the SEC has to step in and tell Hertz, no, you can't issue worthless stock, even though there's hundreds of buyers for it. We won't let you do that. What kind of world is this when the individual investor craves worthless stock from a bankrupt company with no future, given the electrification of ground transportation and transportation as a service from Lyft and Uber and God knows what else? It's just stupefying. And I think evidence of the bullish hysteria that's out there right now.
Well, of course, and that's a spike. A lot of these guys got lucky on the spike because they had a very, very good bear market rally, and of course, you know, success begets success.
Yes.
And if you have a winner, you're actually brilliant. So you're a genius. So we don't want to do that. So we're going to kind of sit on the sidelines for the next 12 to 18 months, preserve I think we're in kind of capital preservation mode. Are we not? I think it's where we want to keep our money. Opportunities are certainly going to come our way. Probably some commodities coming in 12 to 18 months. We might even have some shortages if everybody's locked down and people aren't working. Maybe we need to start thinking getting some agricultural companies into our portfolio. That might not be a bad place to just maybe put some long-term money.
Agreed.
I think the theme here is probably safety. Are we not?
Absolutely.
We should be very, very conservative. Put it into things that are going to be very, very safe and conservative. And we're going to look for probably 23, 24 before things really start moving. And then, of course, the liquidity at that juncture is going to come through the system, is it not? I mean, 23 should be pretty good, I would think.
Yes. Yeah. On the other side of this, I'm very optimistic and upbeat that it will be a better world all the way around. But it's the meanwhile that we have to deal with.
So getting from here to there.
Yes.
So in my business, we still have an 18.5-year cycle in the real estate that we're still kind of in the middle of it. We're not very far out. So I'm thinking we're probably not going to peak until 23, 24, I think is probably where the absolute peak is. So that's a good place for people to go if they're conservative. We wouldn't be telling people to go out there and buy any big box stores at this point, but certainly, mom, dad, and a couple kids and a place to put the dog and the boat alongside the house, that'd be good. Maybe some treasuries, probably a good place to keep your cash.
Yes.
Short-term treasuries, I think, probably.
Absolutely.
Any thought on gold?
Gold? The funny thing is, every financial luminary in the world has recommended buying gold since February, but it's failed to make new highs. Every attempt to rally is met with significant selling. So during the Great Depression, gold deflated, but not as rapidly as other things deflated. So I think gold, being long gold, is just a very, very crowded trade here.
And one more thing you and I have talked about, this is probably the crux of a lot of them, is the dollar.
Yes.
You know,
Yes.
I think we're peaking here. And of course, maybe that's what's holding down the gold a little bit too, because the dollar is so doggone strong.
Yes.
I don't know what gold express. I don't know what would gold be like if you expressed it in lira or euros. Would that be better?
Yes. But you know, we're holding dollars, and I think the next, between now and August, I think we're going to get a test of whether the dollar is still viewed as a safe haven, because I'm looking for a few waves of bad news to come between now and the middle of August. And if the dollar can recover on that bad news, then it's still being viewed as a safe haven, and it's going to remain in its trading range. The dollar had some huge swings down and then up on the onset of COVID-19, and it's created a wide range. And I think the dollar is probably going to be remaining in that range for a while. And that means there's room for some upside here, but within its recent range that was established earlier this year.
When you and I talked before, you had a target of 103.8. I think we hit 102.8. We touched 103 for a little bit, but you thought if we had turmoil in the world, the dollar could go much higher. It could go up to 120.
Yes.
And what we're talking about here, turmoil really hasn't reached the shores yet. And we've had this kind of a shock, and I think we have one more leg down. Do you think that might be the turmoil that drives the dollar up to its peak?
Well, there's a longer term time cycle in the dollar that points down for several years. I still think that 103 and change was the cycle high, and this congestion is the prelude to a weaker dollar longer term. I still think longer term, the dollar's got some problems, some serious problems. But near term, I think there's still this faith that if you're long the dollar, nothing bad can happen to you. That will eventually wear off. And I think the next few months will be a test of whether that is still how people are viewing the dollar.
Of course, that might go right into our what we've been talking about too, because if the dollar starts to drop, could be because all this liquidity coming through the system, and that would drive, if we saw the dollar start to drop, we'd see commodities go up a little bit. We'd see housing go up. We'd see gold go up.
Yes.
So maybe that's the catalyst for it. Maybe it's a falling dollar that makes it is the catalyst to do this. Because you know, when they go up and they hit a peak, it's called a peak for a reason. It means it doesn't go up any higher.
Absolutely.
It comes down.
And I wonder if that next leg down in the stock market is the catalyst for the decline in the dollar, because all the foreign money that's been pouring into the U.S. stock market, because it's the only thing holding the highs, suddenly wants to go home again. All that money wants to go home again, which means they're selling dollars, buying back into their home currencies. Maybe that final leg down in the stock market is what breaks the back of this dollar strength, and inadvertently sets the stage for a recovery in prices and commodities and real estate, just like you mentioned.
Well, so we're going to wrap it up. For most of my clients and a lot of people that are listening to they're really Main Street investors. They're really not anywhere near. No one's going to call them elite. So for them, safety of principle is probably the number one concern you would have, is that you need to really talk to your financial professional, find out what kind of risks that you're taking, assess your risks. Probably lean towards maybe getting out of the bonds as much as you can, because I think bonds are probably hugely at risk, and maybe transferring money to U.S. Treasuries and getting into something very short duration, maybe anywhere from some bills to some really short notes. Huh?
Yes.
And then maybe watch their stock portfolio, talk to your professional on that, make sure that they have the appropriate exposure, because in the next 60, 90 days, we may have an event. So the next 60, 90 days, probably the end of this bear market rally, and we'll see how far down we go. But
Yes.
longer term, we're very rosy. 18
Yes.
to 24 months out, I think we are back to at
Mm.
least a much better economy from where we are.
Yes.
Would you say that's about, I recapped that well?
Absolutely. And if people want to follow my outlook on these things, we have a website, ICAP Technical Analysis. They can sign on for a free trial. Look at all the years of market calls I've been making, tutorials, covering the S&P, commodities, currencies. That's a resource they may want to check out on their own. So.
Well, yeah, particularly in the next 60, 90 days, there's going to be some
Absolutely.
really interesting time to get your advice. Might be a really good idea.
Yeah, the pace of change has been so unprecedented. When I sit down to do my week ahead outlook, it takes as much time as it used to do for my month ahead outlook. And when I sit down to do my month ahead outlook, it takes as much time as it used to take for the year ahead outlook. It's trying to drink from a fire hose.
Yeah, right.
There's just so much going on. It's a really challenging to keep my clients on top of things and avoiding the potholes and on safe ground. It's very challenging times all the way around.
Well, it's a Chinese curse, isn't it? May your life be
Oh my God. Please, can it be less interesting next month?
Walter Zimmermann, thank you very, very much. We're going to stop the recording right now. So, Walter, thank you so very much for your time. It's been great, deeply appreciated.
Thank you for having me. Okay, bye-bye.